As of the weekend market close on Friday, June 26, 2026 at 4 p.m. Eastern Time, NUBURU Inc., trading under the ticker symbol BURU on the NYSE American, sits at an exact price of $0.141 per share, marking a heavy intraday decline of 21.67% during the final trading session of the week. This drop adds to a sequence of wild daily swings, with the stock oscillating between an intraday low of $0.1378 and a high of $0.1482, pushed along by a massive spike in trading volume that reached over 10.88 million shares. For a microcap stock, that kind of volume points to intense speculative trading and institutional juggling. While retail investors keeping an eye on their Robinhood app or browsing popular investing sites might see this sub-15-cent price tag as a complete capitulation, the reality unfolding behind the scenes completely upends that expectation. While the stock price is flashing red, management has quietly been reshaping the company from a struggling industrial laser component supplier into a highly specialized European defense and underwater power asset. The common ground among most market participants using self-investing tools or an individual brokerage account is that microcap stocks trading under $1 are a straight gamble. When you see a stock down more than 20% in a single day, the standard reaction is to assume a dilutive financing death spiral or imminent delisting. That expectation is entirely reasonable given the historical data. However, the underlying reality here is a complex corporate pivot into high-stakes military contract pipelines that the broader market has not fully priced in. Just days ago, NUBURU advanced a $2.2 million blue laser rover project through its Italian subsidiary Lycon, aiming directly at 2026 revenue targets. This development builds upon a far larger strategic blueprint, a massive $336 million European defense and security platform centered around their planned 70% acquisition of Tekne. By establishing this Italy-centered, software-driven architecture, they are intentionally structuring a business that bypasses United States commercialization barriers while positioning themselves as a vital contractor for allied foreign governments. The tension between this massive institutional transformation and a 14-cent equity price creates an extraordinary anomaly that forces serious investors to look past the surface noise of the daily ticker. Looking closely at recent stock movement, the volatility has been breathtaking. Over the past month, trading volumes have regularly broken past 20 and 30 million shares a day, proving that this is a highly active battleground for short sellers, day traders, and smaller institutional desks. If you look at platforms like Interactive Brokers or track active order flow on the Robinhood app, you can see that the market is violently reacting to every single regulatory filing. For instance, when the company filed its formal golden power notification with the Italian government to review the Tekne acquisition, speculative interest exploded. The Italian government's review is a vital hurdle because the deal involves a fixed pre-money valuation of 52 million euros and an earnout structure capped near 29.7 million euros. For a company whose own market cap has fluctuated wildly in the $20 to $30 million range, pulling off an acquisition of this scale requires serious financial gymnastics. This is why the equity is swinging so hard. Traders are constantly trying to balance the risk of an NYSE American listing shortfall against the massive upside of a projected 564 million euros in cumulative revenue from Tekne's business plan through 2030. The daily swings reflect a deep structural tug-of-war. On one side, you have immediate macroeconomic pressures and a localized capital crunch. On the other side, you have a rapid-fire sequence of strategic wins, like the newly signed agreement with SunCubes to design blue laser technology for their deep light underwater power platform. This underwater project targets an untapped multi-billion-dollar subsea autonomy and maritime infrastructure market. Yet, despite these announcements hitting the the tape, the stock faces heavy technical resistance. Institutional activity shows a pattern of quick execution and risk mitigation, with large blocks of shares moving through sophisticated platforms like the Interactive Brokers Trading Desk, where sophisticated traders manage complex derivative positions. At the same time, retail momentum on mobile apps keeps the liquidity exceptionally high, turning what used to be an illiquid industrial stock into a high-turnover speculative vehicle. Every time the company releases an update on its laser tech pipeline or its defense initiatives, the volume spikes, creating massive liquidity pools that can cause the price to jump or drop by 20% in a matter of hours. This brings us to a critical inflection point regarding how investors handle specialized tech positions in their broader financial planning. If you're managing your capital through a more traditional individual brokerage account, perhaps using Fidelity Brokerage or reviewing diversified Fidelity mutual funds to establish a stable core portfolio, a stock like NUBURU can feel completely out of place. It does not fit into a conservative, hands-off strategy like Schwab Intelligent Portfolios or typical robo-advisor accounts that emphasize steady blue-chip exposure or liquid Fidelity ETFs. Online investing in microcaps requires an entirely different framework for analyzing risk. In a traditional investment setup, you look for steady cash flow, predictable earnings, and a clean balance sheet. With NUBURU, you're analyzing a restructuring story where the legacy business model failed to achieve scale, and survival now depends entirely on securing regulatory approvals from foreign governments and hitting milestones outlined in a strict compliance plan. It's an environment where expectation and reality are separated by a razor-thin margin, and tracking institutional positioning becomes far more important than looking at backward-looking financial metrics. To understand how NUBURU arrived at this 14th of a dollar reality, we have to look at what NUBURU actually does at its core. The company built its reputation on developing and manufacturing high-power, high-brightness blue lasers designed to fundamentally improve welding and additive manufacturing. For years, the industrial expectation was that blue lasers would change the game for processing metals like copper, gold, and aluminum, because blue light is absorbed by these materials at a rate up to 20 times higher than standard infrared lasers. The business model was based on selling systems like the NUBURU AO150 and the NUBURU BL to automotive manufacturers, battery producers, and aerospace firms. But the reality fell short of those lofty expectations. The industrial sales cycle proved to be agonizingly slow, capital requirements were brutal, and generating sustainable top-line revenue became a massive hurdle. The financial reports tell a stark story, with revenue figures hovering near zero in recent quarters, while operating expenses and interest costs on outstanding debt created a heavy capital drain. This widening gap between industrial promise and financial reality is what ground the stock down from its historical highs to its current microcap status. This historical underperformance is precisely why the current shift toward a defense and security framework is being met with such intense skepticism by traditional analysts. When a company faces an NYSE American equity shortfall and has to negotiate complex warrant exchanges, traditional investment metrics break down. However, the pivot to a defense-focused model through subsidiaries like NUBURU Defense Limited represents an entirely different strategic direction. By moving away from purely commercial industrial manufacturing and leaning into high-margin sectors like directed energy systems and counter-UAM systems, management is trying to capture rapid-growth military spending across allied regions. Their recent binding agreement to create a dedicated laser arm with sun cubes, supported by a staged €1 million investment, shows they are actively building specialized tactical capabilities. This is no longer just about welding copper battery tabs, it's about projecting power through the air and underwater, providing wireless power beams to submarines, and deploying hardware for border security and defense mobility platforms. Comment below how many shares of NUBURU stock you currently hold, or if you're entirely avoiding microcap tech stocks in this volatile market environment. It's always fascinating to see whether people prefer to allocate speculative capital through a self-investing account or keep their focus entirely on safer large-cap names. When you look at the macro picture, this stock highlights the stark difference between self-investing on modern platforms and trusting an automated system like an intelligent portfolio. If you're using advanced tools through the Interactive Brokers platform or managing an active portfolio via the SoFi Active Investing Desk, you can pick apart these specific operational catalysts and trade the daily swings. You can treat the asset as a pure option on foreign defense approvals. But for the vast majority of investors utilizing a standard Fidelity mobile app or setting up long-term retirement accounts through Fidelity IRAs, a situation like this serves as a cautionary reminder of how fast technology risk can erode capital if a company fails to monetize its intellectual property early on. The massive contrast between the immense theoretical value of their blue laser patents and a $25 million market capitalization is a direct reflection of the market's lack of faith in their near-term liquidity and execution. Looking forward, the future outlook for NUBURU is bound to several binary catalysts that will either trigger a spectacular short squeeze or force a painful restructuring. The first major hurdle is the upcoming October 2026 deadline to meet the NYSE American listing standards and regain full regulatory compliance. If they fail to shore up their stockholder equity or stabilize the share price, a forced move to the OTC markets could drastically cut down their institutional trading volume and limit